Let's get back to the broader markets. Big tech in focus this week with Meta earnings last night. Two more Mag 7 names out tonight. Joining us for more on the markets, Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Savita, always good to see you.
Great to be here.
You've gone from bullish to neutral.
Yeah.
What triggered that?
Well, I mean, neutral on the market, but bullish on big parts of the market. And I think this earnings season is really showing kind of an interesting differentiation between the haves and the have-nots. Even within mega cap tech, we've seen the companies that have been able to monetize AI or show, surprise on revenues really outperform, whereas those with high expectations but no delivery have lagged. So I think that's kind of where we're at this point. We're kind of done with that easy money from big tech and, this idea that AI is a new thing that's driving CapEx and growth. But I do see strong signs for cyclicals from here. So that's what I would press as we move into the second half.
But going back to the AI trade, before it was sort of a blank check that investors wrote. Spend the money, we believe in you, the AI returns will come.
Yeah.
This quarter, there's a little bit more discrimination among the names.
I think
is that going to be a continuing trend, or are we going to go back to that blank check mode?
I think we're going to more of a show me trend, like kind of what we're seeing right now, which is, okay, everybody is spending on AI. Who's actually using it to make money? Where are we seeing the big surprises? I think revenue surprises are going to be more important than just earnings surprises. So what we've seen so far this quarter is that revenue beats have actually been a little bit less than average. And that's what I think we need to see in order to keep this thing going. So, on the overall index, our target is 5,400, which is a bit lower than where we are today. But I think the idea is, the index itself is probably going to move higher over the next 12 months. But we're heading into a pretty interesting patch right now. So think about it. We've got August, which is typically a seasonally weak month. September as well. And then we've got this election coming up, which generally tends to drive volatility a bit higher. So I think that this is a time where you really want to pick your spots.
And theoretically, a re-steepening of the yield curve is on the horizon.
Indeed, yeah.
And so does that add sort of for the volatility forecast for the markets?
I think it's actually, good for certain spots. I think financials could do well in that environment. We're finally in a phase of the yield curve that's good for financials after many years of being, in a flattening environment. We've got a sense that inflation is contained and the Fed is likely to begin cutting sometime this year. We think December, our economists are penciling in December as the first cut. But the idea is, okay, we're at peak rates on the short end. We've got a steepening yield curve. We've got growth surprises here and there. I mean, CapEx guidance has remained very strong despite all of the reasons that companies have to kind of stall and delay projects. So I think we're in a pretty good spot for the economy overall. Where I worry is about just the really crowded areas of the market that aren't necessarily delivering, and those are primarily growth, secular growth rather than cyclical growth. I think we could be in an environment where you want to buy traditional CapEx rather than just AI CapEx. So those are some of the trends that we're leaning into.
And dividend payers.
I know this sounds a little wonky, but if you think about it, the Fed is about to cut rates at the short end, we think. And that means the cash yields drop. Where has all this retiree money gone over the last couple of years? Into cash, into short duration bonds. And retirees are looking for investments they can live off of. They need a real rate of return that is healthy. And I think that dividend yielding stocks offer that real rate of return that is much more attractive than even 10-year bonds at this point.
So cyclicals that pay dividends? I mean, if you're to overlay the two.
If you match them up, you get this nice intersection of dividend growth, industrials, financials, energy. These are some of the spots that we're finding these companies. But I think there's a lot to look at in the S&P. Maybe not the darlings that have worked so far this year, but there might be other areas that start to outperform.